The Silicon Valley Bank has started to collapse, and we are seeing that this is just the beginning of the collapse. There are other banks that are falling in line with this collapse. Now, to put it simply, what happened with the Silicon Valley incident was there was a bank run, more demand than supply, and now the question that we're all asking is, how can this bank not have everyone's supply? How can they not have everyone's deposits? Isn't that what they're supposed to do? They're a bank. Now, there's something called fractional reserve banking, which basically entitles banks, which are regulated by the federal government to an extent. You can keep a certain percentage of the deposits in your bank. It's all digital, of course. And the rest you can lend out, you can use as arbitrage, you can hedge your bets. So banks will often put their money in bonds, treasuries, different assets that they think will at least beat the market or beat inflation, and they make the money in between. That's the arbitrage. Sometimes they go for a higher yield, and in that case, they're leveraging their money to an extent that is a little bit more risky than what we would consider what a bank should be doing. Now, in this case, Silicon Valley Bank was a bank that worked with a bunch of startups in Silicon Valley, and that meant that they were taking on a lot of risk when it came to these businesses don't really have a track record, they don't have any kind of credibility, and so they're working out a transaction, an exchange, and this bank was taking on investments off to the side using that fractional reserve system, and they were leveraging themselves to an extent where they could not pay back people's money in an event such as this. Now, typically speaking, any kind of bank run could happen at any moment, even to the big banks. Most banks only have a certain reserve that they have. They take the extra money and they lend it out, or again, they put it in bonds. They're trying to find a yield. They're trying to make money off the money that they've received in deposits. This has triggered a response with the rest of the banking system. We're seeing that if you look into the data, into the numbers, a lot of these other banks actually have worse stats, financially speaking, than Silicon Valley Bank. And we're starting to see banks like First Republic, they're going down. So we really don't know how deep this goes. Now, a lot of people in Silicon Valley are saying, we need to bail out these banks. These are small regional banks, but they have a lot of money that is tied to people's jobs, it's tied to startups, it's tied to innovation. We have even some politicians or former political activists, political candidates like Andrew Yang saying these are the bread and butter, or at least the catalysts for innovation, for advancing society. We have to use taxpayer money because that's how you bail them out. The government is going to use taxpayer money to bail out these banks. Now, the Federal Reserve and people within the government, the Treasury Department, like Janet Yellen, they will come out and they'll say, well, we have certain tools that we can use in certain, I don't want to say banks, but certain banks, certain buckets of money that we have, that we've accumulated over time for this purpose, to bail out these banks. Well, we're still using taxpayer money. They're still using our money to bail out the depositors. The depositors were not your average Joe and Jane. The depositors were people, not people, but companies, structures of people who were worth hundreds of millions of dollars or tens of millions of dollars, and they had put all their money, or a majority of their money, 80-90%, with Silicon Valley Bank. They took that risk instead of taking their money and spreading it out, because if you have up to 250,000, you're FDIC insured. They had tens of millions in the bank, and of course only 250K is insured by the federal government. The rest is up for debate. Now, I'm not saying you go and create accounts with, you would have to create accounts with thousands of banks to cover tens of millions of dollars, but you would have to spread out your money at least more than 90%. I mean, they have 80-90% of their money in Silicon Valley Bank. They would have to take that and disperse it into different banks. That way, maybe you have 10% here, 15% here. And a lot of these institutions, in tandem with Silicon Valley Bank, their agenda was to fight for diversity and equality of outcome. So they were spending millions of dollars on political activism that was not really furthering the goal of individual rights, which is more important in the United States of America, really the world, compared to we need to have a certain amount of Hispanics or blacks for this board on this company. They were spending their time and their money on issues like that. And of course, we're not focusing on the financials. There's also a lot of things going on behind the scenes. You had certain people in finance, like on mainstream media, and then you had even insiders within Silicon Valley Bank sell their shares while they're also promoting the shares. So some insider issues going on there. Now, with the whole idea of should banks like this be bailed out, The federal government has already come in and said that they're going to do what they can to help and ameliorate the situation. So they're going to use our taxpayer money to bail out the 1%. We should be focusing on the free market. The banks, the depositors, you all were supposed to be doing your due diligence. You were all supposed to be strategizing, being tactful about your situation and where you're going to put your money. Of course, both parties are responsible. So we need to let the free market win. The free market should play out as is. If that means some banks are going to fail, then they're going to fail. Why all of a sudden are these banks and these institutions, these companies allowed to privatize their gains but socialize their losses? So anytime they make money, right? That's part of capitalism. Anytime they lose money, they hit up the federal government. The federal government uses our taxpayer money, and their losses are bailed out and they get their money back. That's not how you have a true capitalist laissez-faire society. Now, what this also does, let's say we let the free market play out, this contributes to an agenda of the bigger banks, the bigger institutions, let's say taking advantage of the situation, if not orchestrating a situation akin to this, where they get rid of smaller banks so you can only go to the bigger banks. So now you have a consolidation of the bigger banks. Now we know there's the big four, but there's a consolidation of the bigger banks, the bigger institutions. And so more and more of the population are not going to be able to find a regional bank. They're going to have to go to the bigger banks. Now, when you create an oligopoly, because let's say you use a few institutions at this play, you are at the whim of their products and their services. They don't have to be as competitive because they know you only have so many options. You can't go to this bank or this bank or this bank. You only have a few options. And so you'll have a few of these institutions who will often communicate with each other. And that's why right now, if you look at the big big financial institutions, the big banks, they're offering very close to 0% interest rate. Whereas if you look at your online banks, which have high yield savings and such, they can offer 3-4%. And they're adjusting as the Federal Reserve increases their interest rates. And so we're seeing that they don't have to be competitive. They have a lot of overhead. They have a lot of administrative costs. They have they have brick and mortar, right? But they're not able to be as good of a service or create as good of products compared to when you have competition in the marketplace. So we're kind of like, it's a catch-22 because we don't want to bail out the banks by using taxpayer money. That's not what the majority of people are paying into the system for. I mean, we're forced to pay into the system, and at this point we're being taxed heavily, but we don't want our money to bail out the 1%. That's not the point of us paying taxes. That should be going towards infrastructure. We also, at the same time, don't want to have a consolidation of institutions where there's less competition in the marketplace. So we have a ton of different interests here. We have the federal government, and the federal government breaks down into also private institutions like the Federal Reserve. Jerome Powell, the chair, he is part of the federal government institution. He's appointed by the president. But all the rest of the Federal Reserve is a bunch of private banks. They're a bunch of private entities. And so they have a large influence on what Jerome Powell is going to do and just overall what the Federal Reserve is going to do. And then you have big tech, Silicon Valley, all these startups, where they have, I think, like Roblox, Roku, these are some companies that had their money to Silicon Valley Bank. They have interest. And then you have all the regional banks, and then you have the big banks. And so we're seeing a ton of different interests align here. And already what's happening is the Federal Reserve is bailing out these banks. And they're saying that's because they're trying to save jobs, they're trying to save innovation, they're trying to save people's livelihoods. Fair, but you have to let the free market play out. But if we let the free market play out, we're consolidating banks. And so we're losing our opportunity, our consumer choice, which is a derivative of individual rights. So the true answer, the true solution is, okay, you let the free market play out. At the same time, the federal government should step in and incentivize competition in an industry where there is little competition. And so if naturally you have these banks that are going to eat up these other banks, they see an opportunity, they're in the red, they're going to buy them out for pennies on the dollar. Well, the federal government needs to come in and incentivize competition to provide more consumer choice. The problem is when the federal government is colluding with these bigger financial institutions, you're not going to have a government that is for the people's interest. And so they're not going to incentivize competition because that would go against their personal individual, as a politician, their personal individual interests, because they're aligning themselves with the banks. And maybe they're getting a kickback. Maybe they're getting, at a certain point behind the scenes, there's a lot of corruption. We know lobbying is legal, but behind the scenes, There's money that is flowing to institutions, and the institutions are offering jobs to certain politicians. If you're on this certain committee that is going to be ruling what's going to happen in finance, there's a lot of backroom deals. But we need to hold all of these institutions accountable. I know we don't elect those financial institutions, but we have to wake up and realize if we're not using our voice, if we're not committing action to certain enterprises that are happening in America, we will lose the free market system. We've already lost it to an extent. There's crony capitalism. There's socializing the losses, privatizing the gains. That's not true capitalism. There's a loss of consumer choice. And so we're ending up with these fractured industries that do not serve the people. Whereas we want to have different industries that exist and they compete. And when they compete, they actually advance society. When you get a bunch of different companies and they're vying for the consumer's money and attention, they have to increase their technology. They have to create a better priced product. They have to create a better product or service in general to get that consumer attention. When you don't have to compete for that attention or money, you can just get it because it's a service that people are required to use. People have to take their money and deposit it somewhere. They can't just stuff it under their mattress, especially when we're headed towards a digital system. That now presents danger to the public good. This also creates a catalyst for centralized digital currencies. And now you can have a federal government who's working with these oligopolies, these financial institutions, and they will say, we're changing the digital system and we're creating a Federal Reserve token, a Federal Reserve note. And with that, they can control the money. They can control, let's say you're paid $2,000 a month. They can partition it. They can say $1,000 is going to go to your rent. That's the max amount you can use for rent. You have to use it within 30 days. Otherwise, the money expires. So you don't really have an option to save. Only this amount can go towards meat. Only this amount can go towards gasoline. And so they want more control over the monetary supply. This is how they usher it in slowly over time. They can't do it all at once. It would wake too many people up. It's a very complicated infrastructure to implement with the mass population that we have. But when you have disasters like this occur every now and then, you can move the needle closer towards that authoritarian ideal. And so we're seeing a bunch of negative actions happen right in front of our eyes, and no one is really waking up.